there are some massive contrarian indicators showing up for the S&P, NASDAQ, and traditional markets, and Bitcoin could be following in those same footsteps. Let's take a look at how that could play out for BTC and of course the stock markets, and go back in history. Nearly 12 months ago, we looked at the cycle low coming into the markets, and I'll show you just how we were recapping that. So if you haven't already, hit the like and subscribe button. You know what it is. It's your home of macro cycle analysis, where we study the past, and I'll do that in today's video, to forecast the future. And it's great to look back on things that are 6 to 12 months old, even further, 2 years if you want, so that you can see how the calls have been playing out. Now, not everything is 100% accurate, and you will need some sort of experience and education in how to forecast these markets. But like I've talked about before, if we can stick around long enough, you will get the hang of it. This is the video in question, and I'm going to go back to that. It's October 29, so 11 months ago, calling for the lows here. Anyway, let's get on with the video and look at these contrarian indicators that are potentially great news for Bitcoin and the stock market. And this is a contrarian indicator, so it's going to go against what the masses are thinking and saying right now. They're still very, very bearish. You know, we hear those calls all the time on Twitter and on YouTube, and basically the news as well. And if you're not hearing them, you must be doing something right. You've cleared out the noise, the fear porn that you see on YouTube, all of those bearish titles, and the doom and gloom saying that the world will come to an end and the markets need to collapse, and it's going to happen soon in the next week, month, 6 months, 12 months. Nothing in the data is suggesting that these markets are going to collapse, regardless of whichever narrative. So this particular pessimistic outlook is declining for the masses. The chart below displays those times when the 10-month moving average of this indicator, the green line in the chart below, so this right here, crossed below 35%. The most recent signal occurred at the end of August, so it's quite recent, just a couple of weeks now. No investor should look at the results above and assume it's smooth sailing for the next 3 years. Of course not, but the data is showing that it is up. Nevertheless, the recent signal does fall on the favorable side of the weight of the evidence ledger. So there's a few indicators within this, which is a good thing. I prefer seeing that rather than just a single indicator, something like what we've looked at before, where people just suggest, well, September's are red, therefore all September's, the majority of September's should be red. We'll get to this in a moment for BTC. But first to this indicator, it's essentially the consumer confidence. So consumer confidence regarding investors' expectations for stocks in the year ahead just crossed a significant threshold. So this is from the data here. This signal, though infrequent, has tended to portend a favorable stock market, but not bond market, okay? So the indicator, down indicator, is a monthly indicator that shows the percentage of consumers expecting stocks to decrease according to a monthly survey from the Conference Board. Like many sentiment indicators, it's a contrarian indicator. High readings as the masses become overly bearish, and reversals from high readings tend to be bullish for stocks. So you want to see reversals from high readings. The masses were very, very bearish at the bottom, which we talked specifically about in this video in October, looking at this being the low, being a very significant low. We weren't sure if it was the cycle low, but we were very confident this would be a significant low, just like we were with the June low. That was a very significant low, June 2022, and the market only went slightly lower. At the time, yeah, most were saying, well, you were wrong, it went lower, yada, yada. But when you look back, which is exactly what we were talking about, the idea is to be buying up at the lows, not the low, because essentially it's pretty hard to just put all of your money in at one time and get it exactly right. So you want to have indicators, signals that give you an idea that you're rounding the bottom and you are basically buying in at the bottom, the DCAing effect, using timing, which is exactly what we talk about here. So this particular one, great work. If you guys go back and do this, I would definitely go back and check out the videos that you are looking at. So Jay, it's very cool to come back and see this video, which happened to be right after the low. I think you were the only one talking about the reversal. There were a few others, of course, but the majority were definitely talking about the stock market collapsing further than 3,500, and unfortunately some still are, yet the market is now up 15, 20-ish% from those lows. So what does this indicator show? This indicator shows 1 month later, 100% hit rate that the market is going to be higher. There are only 5 points here, 1, 2, 3, 4, and 5, and we're into our 6th point. So take it with a grain of salt, but what I'm doing is layering it on top of the other indicators that we've used here on the channel. And a lot of the data is suggesting these markets are going to be up in the next potentially 3-6 months from now. 3 to 6 months from now. It's not that far away. Day to day, anyone's guess, but longer term, everything is looking pretty well up. 3 months later, 100% it was up in this case by 4%. 6 months and 9 months got one wrong I say, but really it was probably the best time to buy. And it looks like it was around this period here in 2010, which was coming out of the global financial crisis, the crash 2008, bottomed in 2009, and basically the market rebounded very, very strongly from that point and needed to have a pause for a longer period of time. As that shows up in the chart, it was a very strong bounce out of that low and caught many by surprise because, of course, as they always do, they're expecting a bigger collapse. And what were they doing? They were pointing back to 2000, 2001, 2002 because you had a pretty long bear market there. I remember being in the market this time because I had property, and then I started trading in 2010 at these lows here, and everyone was looking for bigger collapses, and they were just looking back here. Well, it happened last time, it's going to happen again. Market put in a higher low, bounced, put in a higher low, and then continued on from that point. But looking at the data that we're seeing here, this contrarian indicator, 6 to 9 months later, it wasn't up at that point, but it was a much better time to be buying because you had the dip on this indicator, which then was up 3 months after this one here and 6 months after this. So it was up 1 year later, it was up 2 years later, up 3 years later. 3 years I think is a bit far for this, but it could work out. But let's just take it quarter by quarter because this is a monthly indicator. 1 year later, 16%. So if we had 16% from the current prices, where would that leave the S&P 500? It's going to leave it pretty high up. So we're sitting at about 4,500 right now. 15%, 16% is roughly 5,200, well above the old all-time high. So in 12 months' time, we're going to be above that all-time high. I've talked about that on the channel. I think we're going to see a new all-time high for the S&P and the NASDAQ, maybe late Q4 or the first half of 2024. So within that sort of 9-month bracket, but I was talking about this quite a while ago when we looked at the breakout in June. We're getting onto the Bitcoin pricing in a moment. Just have a look at the last couple of indicators here. 9 months, well, it goes 6 months from now is 10%, and 9 months is roughly 10%. So 6 months from now, 10% above the current prices puts the S&P at around 5,000. So still above the old all-time high. So things are essentially lining up for this to continue higher. And if this continues higher, then what we've looked at before for BTC is that once the S&P gets into its first all-time high from the pullback, which it's in a pullback now, we need to get into this all-time high, then we expect it to come back and then go for that second attempt at the all-time high. Roughly speaking, based on history, that's when Bitcoin is ready to go off to the races and just go for this pretty big boom. And in terms of timing, we're looking at that somewhere in the second half of 2024. Maybe if it comes later, first half of 2025. But I think it's possibly going to be within the second half of 2024. So this is where we're at, looking at this contrarian indicator. 2 years later, phenomenal, 26, 27%. Then 3 years later, 31%. Let's wait till we get there. But of course, for bonds, it's the opposite direction here. It's going to be negative for bonds. And one of the biggest things we heard over the last couple of weeks is you're not looking at the 10-year treasuries. The 10-year treasuries at recent highs of 10 or 15-year highs. And that was supposed to collapse the market. It's another layer, another step in the wall of worry. It's another brick going up there, wall of worry, 10-year treasuries, they're at highs, everything else is going to collapse. Yet again, the wall of worry strikes and everyone is waiting for further downside. But the market is not showing that downside. We've had some pretty good time from this low in August. Market is bouncing, it's holding out. I'm not saying it's going to be smooth sailing to new highs, and we just still have that August-September period where it might be a little bit choppy and churny. But in terms of the monthly returns, it may not be red, or it may not be as red as many are hoping for. And when people say red, I guess a lot are expecting a further collapse, like bigger downside. August has been a pretty good bounce, and maybe September is going to be that bit of a flat month after a solid move down and then a pretty significant bounce up. The VIX is also showing that it's likely we're not going to see further collapses. The VIX is back down at fresh-ish lows of the last month or so. When I say that, fresh-ish lows is that the lows came in at around July, and now in the last couple of weeks, we've seen some good closes below those levels. And it's only just recently in the last week that we started to move up. The VIX, the volatility index, is telling us what's going on with the SP500. When you get spikes, that's typically some lows for the S&P. What you want to look out for is a rounding bottom and then quick spikes up. That could lead to the end of the rally for the S&P and basically the top of the market, and we get a significant spike down like we saw with the COVID crash, like we've seen with the crash in 2018, 2019. But at the end of the day, the bull market continued on, even with these big crashes that hit 35 on the reading. So stay aware, markets are still up, everything is trending up. NASDAQ is still in some pretty good territory here at pretty high prices after the scares of the last month. The US is also hitting new all-time highs. US households net worth levels hit new all-time high. If you're not following on Twitter, go and do that because there's plenty of data that I've got over on Twitter. This is contrary to what the masses are also saying. Everyone's saying people are running out of money, credit card debts are high, interest rates are high, therefore prices are going to start coming down. Household net worth level is at high. What I'm saying here is more money, so there's more money there. That's the data. The data's saying that the net worth is higher now. Typically what we've seen in the previous cycles as well means more spending because people have more money, they feel more wealthy, there's more spending. That means higher prices overall, which then flows back into the real estate prices, the land prices. When prices go up, then basically the profits flow back into the land values all around the world, no matter which sector we are in. So full-blown recession could be further away than most are hoping for. We know that the recession calls have been pushed out quarter after quarter after quarter after quarter after quarter. If you keep going on with that, then of course, eventually it'll be right, but we're not expecting a recession in the next 6 to 12 months, or at least let's say we're not expecting prices to collapse past significant lows, which are more important because we trade the charts, we don't trade the word recession. Remember that as investors. We do think there'll be a big collapse coming, but it's not anytime soon, okay? Max pain to the upside awaits, and I'm saying bookmark this because I think it's going to happen. We're going to get a max pain to the upside, and that I think is going, this is the macro sense, that is going to catch a lot of people off sight. That's the max pain we're all looking at. Now, BTC, can this pattern repeat on Bitcoin? Well, we looked at the Contrarian indicator here. In terms of the monthly returns that most are looking for and they're waiting for is a red September or pretty big downside. As I pointed out, it doesn't seem like we're going to get these huge downside moves for the S&P or for the NASDAQ. The VIX isn't saying it, and we're seeing more and more money come into the system here, or at least households holding it. Could it happen for Bitcoin? Yes, we've looked at 23,600, but is it going to be that collapse to the downside that I think a lot of people are waiting for, this collapse past 19.5 or 15.5. It doesn't seem so at this stage. Can it happen for Bitcoin? Of course. There's always going to be any sort of possibility of wicks when liquidity is dry, and it's especially dry when the market is quiet and you're getting those small trading ranges compared to the moves to the downside and these moves to the upside as well. But in terms of a closing basis on multiple weekly or monthly, at this stage, it's looking unlikely that we're going to start closing underneath these levels to then put in new, fresh lows based on timing, based on price, based on history. It doesn't seem likely. So if we do get these drops to key support levels, 23.6 as being one of those, then I'm using those as buy the dip opportunities. Is September going to be red? Of course, it's possible. What we've seen in the past, multiple red Septembers, 1, 2, 3, 4, 5, 6 Septembers in a row have been red. We've also had 2 red months in a row. Does that mean we have to see another red? Of course not. It doesn't necessarily mean that. And maybe we're coming to the end of the red streak. Does green mean that it has to go to new highs and break 32? No. That's the point. The point is we could be in this trading range and get a green September and it not really mean anything to the market, because it could just be a little push down, test those prices, and then come back up and trade below August high, but be a green September. So there could be the crash and a bounce back, and then October just could be small again. That is the point when it comes to hoping for bigger downside. It doesn't necessarily have to be exactly like the past. And if we start to weigh up the probabilities of getting 7 in a row, plus 7 Septembers of red in a row, plus 3 in a row consecutively for 2023, it starts to weigh on the side of maybe it's not going to be as bad as most are hoping. Now, if we do get that dip, this is going to be very, very helpful to be able to buy that dip. And the reason is that it is our 6-monthly and 12-monthly forward returns from the past. So looking at the history of BTC and what's happened from September until March. So a 6-month return and then also a 12-month return. If you bought in September, what would the return be like 12 months from now in the following September? Now, I looked at this in a previous video, but the importance here is to be able to have those, I guess, if you want to use an analogy, the balls of steel, to be able to get into the market at those buy the dip opportunities. And I guess use some of the history, not saying it has to happen exactly, but this is all we have to work with, that in 6 or 12 months time, the likelihood of the market going up, or at least being in a positive, is much higher when you do buy the dips with these other criteria, with the other indicators. We're looking at the overall market being in a bull market and potentially giving us a buy the dip opportunity. So looking at the 6-monthly returns, September 6 out of 10 times has been green. But if we take out some of the reds, basically from the bull to the bear market, the real bearish years, then this starts to look a little more healthy, like a 7 or 8 out of 10 times, basically a 70 or 80% return rate. So as long as you're not getting in on the bearish years, 2018, 2019, obviously bearish year, 2014 and 2015, bearish year. The top was late 2013, it dropped into 2015. So you can start to pick apart some of those worst times, which was 2022, and put the odds and the probability more in your favor. When we look at 12 months for forward returns for Bitcoin, September to September, the worst years were 2014, 2015, so it was a 50% drop, and then the 2021 top into 2022 was another 57% drop. So we've seen those big bad years, and typically you see 1, 2, 3, 4 green years in a row, 1, 2, 3, 4, 5, 6 green years in a row, and it seems like we might be on that path again for at least a few green years or green Septembers to Septembers in a row. So I'm just trying to throw those probabilities in my favor, so when those opportunities come up, it's going to give me that headspace that I need to be able to buy at lower prices and time these markets in a relatively perfect, let's say, fashion. Now, not all crypto is created equally. Bitcoin, I'm treating separately to ETH and the rest of the market. ETH is still sitting in a slightly weaker position here, getting closer to its major 50% level at $1,500. There's also a bit of a space here down below between around 13 and 1,500 if this market falls into that space underneath the 50% level, which is a weak position. If it goes under the 50%, that is a much, much weaker position. So be aware of that if ETH does come down that low. As for the rest of the cryptocurrency space, I'm only picking on Solana here, but you can apply this to basically almost every single other altcoin, and maybe yours is the special one that it doesn't apply to, but most look like they still have another 50% drop in them. If we look at, as I said, I'm just picking on Solana here, to the next support levels, should it break down from these lows, which I think it could if Bitcoin has that drop, then we could be in for another 48, 50% drop to those support levels of Solana against its BTC value. So keep that in mind if you're looking to be buying the dips on any of these coins. Pull up another crowd favorite, ADA. I haven't even done the analysis on this. If that is to drop past these lows from the current price to the next lows, you're looking at a 48% drop. If it wants to go even further, then you might want to get the tissues out. That's going to be a little bit painful for a lot of people. So keep that in mind if you are trying to DCA into altcoins. They're not all created equal, and they are definitely not in as strong a position as BTC is. Like and subscribe, guys. I'll see you back at the next video. And if you haven't already, the link in the top of the video description is for our free crypto and economic report coming out this week that's going to go through a lot of this information in more detail. So click on that. You've also got trading guide and discounts as well. I'll see you at the next video. Have a good one. Until then, peace out.